Good day everyone, my name is Mary Charity Priscilla F. Lambusan and here's my 10 facts regarding Chapter 7 Financial Markets. Let's get started! Have you ever wondered how businesses like Jollibee or SM get the money to build more branches or expand abroad? That's where the financial market comes in. It's the system that connects people who have extra money with people who need funds for growth. Alright, let's dive into the 10 quick facts you should know about the financial markets. Did you know that financial markets act as a bridge between savers and borrowers? Yes, they make it possible for funds to move from individuals and institutions with surplus money to those who can use it productively. In fact, financial markets play a vital role in economic growth by making sure money flows efficiently throughout the economy. This helps businesses expand, create jobs, and raise national income. Interestingly, there are two main types of financial markets, the primary market and the secondary market. The primary market is where new securities are issued, while the secondary market is where investors buy and sell existing ones. It's worth noting that financial markets also include debt and equity markets. Debt markets deal with bonds and loans, while equity markets involves shares or ownership in a company. Here's something interesting. One major part of the financial market is the stock exchange. It provides a centralized platform for buying and selling securities, ensuring transparency and fairness in every transaction. Now, did you know in the Philippines, the Philippine Stock Exchange or BSA serves as the main organized market for trading stocks. It resulted from the merger of the Manila and Makati Stock Exchange in 1992, unifying the country's capital market system. Oh, another part of the financial market is the over-the-counter OTC market, where securities are traded directly between dealers and investors. Unlike stock exchange, OTC markets don't have a physical trading floor. Transactions are done electronically. In today's fast-paced market, day trading has become a notable activity. It involves buying and selling securities within the same day to profit from small price movements, though it carries higher risk and requires careful timing. A key point to note, formal financial markets are characterized by liquidity, transparency, reliability, and regulation. These features make them safe, organized, and trusted by investors around the world. Finally, financial markets keep evolving thanks to technology, deregulation, liberalization, and globalization. This makes trading faster, markets more connected, and opportunities wider, but also calls for ethical behavior guided by institutions like the Bangko Sentral ng Pilipinas. And that wraps up our quick journey through the world of financial markets. They're more than just systems for trading money. They represent how people, businesses, and dreams connect through finance. And in this ever-changing world of financial markets, just when we think we've seen it all, new opportunities and challenges await, reminding us that in finance, as in life, nothing ever stands still.
Did you know that money markets keep the world's financial system moving every single day? Let's unpack how with these 10 quick facts. First off, what are money markets? They are networks where governments, companies, and banks borrow and lend money for less than a year, keeping short-term capital flowing smoothly. So why are they so important? Because they provide liquidity, which means quick access to cash that helps banks meet withdrawals, companies pay salaries, and governments manage budgets. So here's the thing, the interest rates in these markets set the tone for the entire economy. They serve as benchmarks for longer-term loans, mortgages, and bonds. There are three users of money markets: banks, companies, and investors. Banks rely on money markets. When banks need extra cash, they borrow from other institutions or issue certificates of deposit to balance their books. Businesses use money markets as well. Companies issue commercial paper, which are short-term IOUs, to cover expenses like payroll or inventory while waiting for revenues to come in. Investors aren't left out either. Those with extra funds from big corporations to individuals park their money here safely for short periods, earning modest but reliable returns. The most trusted tools in money markets are treasury bills. They are issued by governments. T-bills are ultra-safe investments that keep public finances stable and investors confident. There's commercial paper again, a favorite among large corporations because it's cheaper than taking out long-term loans and can be renewed as needed. Bankers' acceptances and time deposits add more flexibility. They help fund trade deals, savings plans, and short-term investments, all while keeping cash circulating effectively. Finally, repurchase agreements or repos. These quick buy and sell deals keep the entire market liquid, ensuring there's always money moving when it's needed. So, did you know the money market might work quietly behind the scenes, but it's the heartbeat of the global economy, keeping cash, credit, and confidence flowing every day.
Good day everyone. Let's explore capital market. Capital market is where long-term funds are raised, usually for more than 1 year. It helps companies and governments get money for projects by selling stocks or bonds. The capital market is divided into two parts: the primary market for new issues and the secondary market for buying and selling existing securities. The Philippine Stock Exchange is one example of a capital market. Investors in capital market can earn through dividends and capital gains. It helps the economy grow because it connects investors' money to the businesses that needs funds. The Securities and Exchange Commission regulates the capital market to keep it fair and transparent. Common instruments traded in a capital market are stocks, bonds, and mutual funds. Unlike the money market, the capital market deals with long-term investments, not short-term loans. A healthy capital market means a strong and growing economy because it shows trust and confidence in businesses. That's all for the capital market. Peace out.
Hello there! Welcome! Today we're diving into one of the most exciting parts of global finance, the foreign exchange market, where the world's money never sleeps. It is the place where currencies meet, trade, and shape the value of everything, from your next vacation to international business deals. Let's find out how this global system keeps the economies connected, one exchange at a time. Let's go! So, every country uses its own currency, like the US dollar, euro, yen, and our peso. But when countries trade, they must exchange currencies. That's where foreign exchange market, or Forex, comes in. Forex is the largest financial market in the world, with over $1 trillion traded every single day. It operates 24 hours a day, 5 days a week, connecting businesses, banks, and investors worldwide. But unlike like the stock exchange, Forex has no central location. It's an over-the-counter market where banks and brokers trade electronically. And at the heart of Forex is the exchange rate. It is the price of one currency in terms of another. For example, 58 pesos is equal to $1, meaning it takes 58 pesos to buy $1. Exchange rates constantly change based on supply and demand. When the demand of a currency rises, its value also appreciates. But when the supply increases, it depreciates. But what influences those changes? There's a lot actually. Factors like inflation, interest rates, and balance of payments all affects exchange rates. High inflation lowers currency values, while high interest rates attract investors. More exports than imports strengthens the currency. Moreover, governments and central banks can also step in. Through intervention, they can buy or sell their own currency to stabilize prices or to boost competitiveness abroad. But after the World War II, exchange rates were fixed, tied to the US dollars. But since 1973, most countries use floating exchange rates, meaning the market can decide a currency's value. And now, here's a key theory: purchasing power parity or PPP. It says exchange rates adjust to reflect price level differences between countries. If prices rise in one country, its currency should depreciate so that goods cost the same everywhere, keeping global prices fair. In short, the foreign exchange market isn't just about money, it's about connection. It links countries, balances trades, and keeps the global economy running smoothly. So, money never sleeps, and either does Forex market, whether you're traveling abroad or studying business or just curious about economics. Understanding exchange rates means understanding how the world's money moves.
Ever wondered how money works when it crosses borders? Let's break it down in the 10 quick facts about foreign exchange rates. Foreign exchange market is huge. It's the biggest market in the world. Trillions of dollars moved every single day. There are two main deals, forward and spot. Forward rates can be higher or lower than today's price. Spot rate is just today's price. Like for example, $1 equals to 58 pesos. You can mix and match exchange rate to get a cross rate. For example, peso to dollar and dollar to yen is equals to peso to yen. In the long run, if a country's prices rise faster than the others, its money loses value. Trade rules like tariff also change exchange rates because they affect how people buy local versus foreign goods. Businesses faces currency risk. Imagine buying goods in dollars. If the peso drops, then you suddenly pay more. To protect themselves, companies use hedging, basically locking in a price so they don't get surprised later. So exchange rates aren't just numbers. They shape trade, businesses, and even your shopping.
Hi guys, I am Irma Jane Humangit, and now let's break down something you hear about all the time, the mortgage markets. Have you ever wondered how people afford big houses or buildings without paying everything upfront? That's where mortgage markets comes in. And now let's go over 10 facts to understand how it works. Did you know that in mortgage markets, borrowers like individuals, businesses, and governments can obtain long-term collateralized loans? So in simple terms, this means that people or companies can borrow big amounts of money for a long period like 10, 20, or even 30 years. But they need to offer something like land or building as a security. For example, if a company wants to build a mall but doesn't have 100 million pesos in cash, they borrow money and use the mall as collateral. So if they don't pay, the lender can take that mall. Here's something you might not know. Mortgage markets make it possible for people and institutions to borrow money to buy a real estate like homes, buildings, or land. So real assets mean actual physical things, not just digital stuff. So instead of saving 30 years to buy a house, you can borrow money now, live in the house, and pay monthly. So imagine, you want to buy a house worth of 3 million pesos, but you only have this 100,000 pesos. So through a mortgage, you can move in now and pay monthly like rent, but the house becomes yours. Quick fact, most mortgage loans are made by financial institutions such as banks, credit unions, or saving institutions, not just the government. So, these are the banks and lending institutions we usually go to. For example, you walk into BPI or Pag-ibig and apply for a housing loan. So, that's them acting as a lender in the mortgage markets. Did you know that mortgages are typically amortized loans? Meaning, the borrowers repay both the principal and the interest monthly. So this means that each month you're not just paying the interest. You're also paying off the amount you borrowed. So let's say you borrow 1 million pesos. Each month you pay 10,000. So part of that goes to interest and the rest reduces the amount you borrowed. So little by little, you own more of your house. Let's break this down. Before you get a mortgage, lenders look into your income, credit score, and even the property's value. And this process is called underwriting. Lenders want to know if you can afford this, are you responsible with money, or if the property worth the loan amount. For example, if you apply for a 5 million pesos house loan, they will ask your payslips, make sure that the price isn't overpriced, and check if you pay debts on time. Did you know that conventional mortgages are not insured by the government agencies? So, if the borrower stops paying, the bank takes the loss. There is no backup from the government. For example, you get a 2 million pesos loan from a private bank. If you default, the bank takes the loss. That's why conventional mortgages often have the stricter requirements. Here's a cool thing. Government-backed loans like FHA or Pag-ibig help more people qualify for home ownership. With this, the government guarantees a portion of loan, making it safer for banks and easier for the borrower to get approved. For example, in the Philippines, the Pag-ibig is a government-run program. They offer loans with a low interest and easier terms, especially for a first-time home buyers. Did you know that mortgage-backed securities, or MBS, pull together many mortgages and sell them as investments? Meaning, these are financial products that turn people's mortgages into income for investors. The investors get paid as people pay for their home loans. For example, a big investment company buy a bundle of 1,000 mortgages. So every time those people pay their monthly dues, the company earns money. Have you ever heard about Freddie Mac and Fannie Mae? So if not, Freddie Mac and Fannie Mae buy mortgages from lenders and turning them into investment packages. They keep mortgage money flowing by buying loans from banks and converting them into investments. In this way, banks can get their money back fast and can lend more. So think of them like loan recyclers. Banks lend money, Freddie and Fannie buy the loans, the bank gets more cash and can lend again. So instead of waiting for years to get paid back, they sell loans, get cash, and make new loans, keeping the housing market moving. Did you know that subprime mortgages are loans given to borrowers with poor credit and were a major cause of the 2008 financial crisis. Banks gave risky loans to people who couldn't really afford them. So when many failed to pay, the housing market collapsed, affecting the whole world. It is like giving loans to 100 people who are already in debt. So if they all stop paying, the whole system breaks down. And that's what happened in 2008. So that wraps up the 10 quick facts about mortgage markets. Whether you're planning to buy a home or pursue a career in finance, understanding how mortgages work is very essential. Hopefully, this overview clarified the topic and made it more approachable. Thank you.
You might have heard the word derivative in finance, but what does it really mean? Let's get to know them better through these 10 facts. Fact number 1. Derivatives get their value from something else. Derivatives don't have value on their own. Their worth depends on another item, which we call the underlying asset. For example, if a derivative is based on the price of gold, then its value changes when the price of gold changes. Number 2. Their value changes when market prices change. A derivative's price moves when the market moves. It can be affected by things like interest rates, stock prices, currency exchange rates, or commodity prices. Number 3. You don't need a big amount of money to start. One of the main features of derivatives is that they usually require little or no initial investment compared to buying the real asset. This means you can control a large amount of value with only a small amount of money, which is why derivatives are often called leveraged products. Number 4. Derivatives are settled in the future. When you enter into a derivative contract, it's not something that happens right away. Instead, you agree now that the actual exchange, whether it's money, goods, or another asset, happens on a future date. Number 5. People use derivatives to protect or to profit. Derivatives are mainly used for 2 reasons: hedging and speculation. Hedging means protecting yourself from risk, and speculation means trying to make a profit by predicting how prices will move. Number 6. Derivatives can make investments more stable. Investors often use derivatives to reduce the ups and downs in the market, or what we call volatility. Number 7. Futures contracts help lock in prices for the future. A futures contract is an agreement between 2 parties to buy or sell an asset, like oil, corn, or gold at a specific price on a set date in the future. This helps both buyers and sellers plan ahead because they already know the price they will pay or receive, no matter how the market changes later on. Number 8. Companies use derivatives to fix prices and manage costs. Many companies use derivatives to avoid sudden changes in prices that can affect their operations. For example, a Philippine airline might know it will need jet fuel in 3 months. To avoid paying higher prices if fuel costs rise, it can use a future contract to buy fuel at today's price for future delivery. Number 9. Some investors use derivatives to earn from price changes. Derivatives can also be used for speculation, which means betting on price movements. For example, if an investor believes a company's stock will go up, they can buy an option that allows them to buy the stock later at today's lower price if that stock does rise, so they make a profit. Number 10. Interest rate swaps are the most used derivatives worldwide. Over 70% of all derivative contracts in the world are interest rate swaps. In this type of contract, 2 parties agree to exchange interest payments. One pays a fixed rate and the other pays a floating rate. This helps both sides manage the risk of changing interest rates. Derivatives are not bad or scary. They're simply tools used to manage risk and sometimes to earn profits. Just like any powerful tool, the key is to use them wisely.
Hey guys, ever wondered why money, stocks, and investment move around the world like one giant marketplace? That's the power of international financial markets. Today, I'll share you the 10 fast facts that will change how you see the global finance. Let's go! Fact number 1. Financial markets are now global, not just local. Investors can buy and sell securities across countries instantly. And speaking of global, for fact number 2, the biggest stock markets are in the US, Japan, UK, and China. But those deep on emerging markets, they rising fast. Now, here's something you should know for the fact number 3. New York Stock Exchange or NYSE is still the largest, but Tokyo and London are also the big global leader. So how huge are these markets? So fact number 4. Massive trillions of dollars move daily through of global trading. Imagine that the money flow. And here's where it gets interesting for fact number 5. Cross-border investment means money flows between countries. Example, a Filipino investor can own shares in Apple or Toyota. But it's not just a stocks for fact number 6. International bonds like Eurobonds let companies borrow money in the foreign currency, often inside their home country. And speaking of foreign country, for fact number 7. Fact number 7. Euro currency are deposits held outside the currency home nation, like US dollars, stored in London Bank. Now, let's talk about a bigger picture. For fact number 8. Globalization keeps pushing markets, bigger things, technology, trade, and even regulations. But who's actually investing? So now, let's proceed to fact number 9. Two big market players, individual investors like you and me, and institutional investors like banks, funds, and insurance companies. Finally, here's the goal for the future. For fact number 10. International standards are being built to create trust, transparency, so that the markets worldwide can play fair. And that's the 10 big facts about the international financial market. Remember, money never sleeps, and neither do global markets. Follow for more financial bites. Thank you!